What if I told you that 2025 could be the year you completely transform your wealth? Not by luck, but by using proven stock strategies the smartest investors are using right now. Whether you've never bought a single share or you've been trading for years, I'm going to walk you through a beginner to expert playbook, and tip number 4 is something Wall Street doesn't want in the hands of everyday investors. Welcome back to Cash Hold, your go-to channel for mastering money, building wealth, and making smarter investments. If you want to grow your portfolio, stay ahead of market shifts, and avoid the common mistakes that wipe out most beginners, hit that subscribe button and turn on notifications, because this year's market is going to move fast, and you need to move faster.
1. Start with the core satellite strategy. Most beginners jump into investing by picking random stocks they've heard about on social media. That's a recipe for disaster. Instead, the pros use the core satellite strategy. Think of it as building a fortress around your portfolio. The core 70 to 80% low-cost, broad market ETFs like S&P 500 ETF, VU, SPY for US growth, FTSE 100 ETF, ISF for UK exposure, TSX Composite ETF XIC for Canadian stability. These give you diversification across hundreds of companies. The satellite, 20 to 30%. Your high-risk, high-reward plays could be small-cap growth stocks, innovative sectors like artificial intelligence, or even thematic ETFs like renewable energy or cybersecurity. Example, if you have $10,000 to invest, you might put $7,500 into a mix of core and $2,500 into high-growth areas. This gives you the safety net of the market average plus the upside of big winners. 2. Master dollar cost averaging. Trying to perfectly time the market is impossible. Even professional hedge funds get it wrong. Dollar cost averaging DCA takes the guesswork out. Here's how it works. You invest a fixed amount at regular intervals, say $200 every Friday. When prices are high, you buy fewer shares. When they're low, you buy more. Over time, your purchase price averages out, reducing the risk of a single bad entry point. Case study. If you had invested $500 into the S&P 500 every month since January 2008, through the 2008 crash, COVID crash, and every rally, you'd have seen consistent growth and doubled your money by now. 3. Follow the 2025 megatrends every year. Certain sectors lead the market in 2025. The biggest megatrends are artificial intelligence, AI. Think beyond just ChatGPT. AI is powering supply chain optimization, medical research, and even government defense contracts. Leaders NVIDIA, AMD, and AI software platforms. Green energy. Governments in the US, UK, and Canada are investing billions into clean energy infrastructure. Leaders: Tesla, EVS, Brookfield Renewable, Clean Power, Enphase Energy, Solar Tech. Semiconductors. With the global chip shortage easing, companies are racing to build domestic manufacturing plants. Leaders: TSMC, ASML, Intel. Pro tip: don't put all your money into one trend. Instead, spread across 2 or 3 to reduce sector-specific risk. 4. Learn the earnings season advantage. Earnings season happens 4 times a year, and it's when companies release their financial performance. Why it matters. If a company reports better than expected profits, the stock often jumps within hours. If they miss expectations, it can drop, even if the business is healthy long-term. Pro strategy. Instead of guessing before results, wait for the numbers and trade on the reaction. Example, Apple reports strong iPhone sales, gives analysts upgrade the stock, gives a short-term rally, follows. You ride that wave instead of gambling ahead of the announcement. 5. Risk management like a pro. Even the best investors lose money sometimes. The difference is how they limit those losses. The 2% rule. Never risk more than 2% of your portfolio on one trade. If you have $10,000, the most you should lose on a single trade is $200. Stop-loss orders. If a stock drops to your set level, it automatically sells, preventing bigger losses. Position sizing. Keep high-risk stocks small. Your core should always be bigger than your speculative bets. Think of risk management as the brakes on a sports car. Without them, speed will kill you. 6. Keep emotions out of it. Fear and greed are the two emotions that destroy more portfolios than bad stock picks. Fear makes you sell during dips, locking in losses. Greed makes you chase hype, often buying at the peak. Pro tip: write down your strategy before investing. If the market swings, stick to your plan. Your portfolio will thank you in the long run.
So, whether you're starting with $500 or $50,000, these strategies can help you build wealth, protect your downside, and stay ahead of the game in 2025. Which one are you going to try first? Tell me in the comments. I'd love to know. And if you want to learn the 3 secret habits that make millionaires in the stock market, click the video on your screen now. This could be the most profitable 10 minutes you spend all year.